What if the metal sitting in vaults from London to Shanghai? The commodity markets trade at 30 times the physical supply. The asset that crashed 90% in 8 months in 1980 is about to repeat that pattern. Most people think silver moves because of jewelry demand or solar panels. They're not wrong, but they're missing the architecture underneath. There's a mechanism that has destroyed silver's price 7 times in the last century, and every technical indicator, every historical parallel, every structural warning sign says it's happening again. In March 1980, silver hit $50 per ounce. By March 1981, it was under $8. That's a 92% collapse. In April 2011, silver reached $49 per ounce. By June 2013, it had fallen to $19, another 61% crash. The pattern isn't random, it's architectural. And right now, 7 distinct signs say we're at the edge of the third major collapse in 45 years. Let me show you how the same trap gets built, the same players make the same moves, and the same outcome becomes inevitable. Because this isn't about supply and demand. This is about leverage, paper promises, and the moment when the gap between what markets say exists and what physically exists becomes unsustainable. The foundation was laid in 1873. That's when the United States passed the Coinage Act, effectively ending silver's role as monetary metal. Germany had already moved to the gold standard in 1871. The Latin Monetary Union began restricting silver coinage in 1874. Within a decade, silver went from being half of the Western world's monetary system to being what economists called demonetized. The price crashed from $1.32 per ounce in 1872 to 63 cents by 1876. That's a 52% decline in 4 years. Think about what this meant in practical terms. If you were a silver miner in Nevada in 1876, you were producing metal that had just lost half its value because governments in Europe decided gold alone would back their currencies. Your costs hadn't changed, your labor hadn't changed. But the metal coming out of the ground was suddenly worth half as much because of decisions made in Berlin and Brussels. The official story is that silver was demonetized because it was too abundant, too inconvenient for large transactions, inferior to gold as a monetary standard. That's the surface explanation. But here's what really happened. The shift to gold standards concentrated monetary control. A nation on a bimetallic standard had 2 valves to manage money supply. A nation on a gold standard had 1. And that one valve was controlled by whoever controlled gold supplies. London controlled gold supplies. London became the center of global finance. The Bank of England, the Rothschild banking houses, the major European central banks. Silver's demonetization wasn't about economics. It was about centralizing control. But silver didn't disappear. It found a new role. By the 1920s, industrial demand was rising. Photography required silver nitrate. Electrical applications needed silver's conductivity. Jewelry markets in India and China absorbed millions of ounces annually. The metal that had been kicked out of monetary systems became essential for industrial civilization. And here's where the trap gets built for the first time in its modern form. When silver has monetary value, its price floor is set by governments. When silver is purely industrial and investment commodity, its price is set by leverage, speculation, and the gap between paper claims and physical metal. That gap is where crashes happen. Every time. The first modern silver crash came in 1920. During World War I, silver had spiked to over $1 per ounce as governments hoarded strategic metals. The United States had passed the Pittman Act in 1918, authorizing the melting of over 270 million silver dollars to sell metal to Britain and India for currency backing. That's 270 million coins, turned into 259 million ounces of bullion. When the war ended, industrial demand collapsed, governments stopped buying, and the price crashed from $1.38 in 1919 to 64 cents by 1921. Another 54% collapse. The pattern was established. War or crisis drives prices up through government demand and hoarding. Peace or resolution brings crash through oversupply and speculation unwinding. But the crash in 1921 was mild compared to what was coming. Because by the 1960s, something new had entered the equation. Derivatives, futures contracts, paper silver. The commodity exchange, known as COMEX, began offering silver futures in 1963. For the first time, you could bet on silver's price without ever touching physical metal. You could leverage that bet 50 to 1, 100 to 1. The market exploded. By 1968, futures contracts represented 14 times the amount of silver actually in COMEX warehouses. Think about that. 14 promises for every real ounce. When silver was 20 cents per ounce, that leverage didn't matter much. When silver started rising in the 1970s, that leverage became a bomb. On August 15, 1971, President Richard Nixon ended the dollar's convertibility to gold. The Bretton Woods system collapsed. Overnight, every currency on Earth became fiat paper, backed by nothing except government promises. Investors fled into hard assets. Silver went from $1.39 per ounce in 1971 to $6.70 by 1974. That's a 382% increase in 3 years. And that's when the Hunt brothers arrived. Nelson Bunker Hunt and William Herbert Hunt were sons of H.L. Hunt, one of the richest men in America. They watched Nixon destroy the dollar's gold backing and decided silver would be their hedge against inflation and currency collapse. Starting in 1973, they began accumulating silver. Not just futures contracts. Physical silver, bars, coins, bullion. They took delivery. They stored it in Switzerland, in New York, in Texas. By 1979, the Hunt brothers and their associates controlled approximately 100 million ounces of physical silver. That's roughly half the silver bullion in private hands in the entire world. The price responded exactly as you'd expect. Silver had been $6 per ounce in 1978. By September 1979, it was $9. By December, $16. By January 1980, $35. And on January 18, 1980, silver hit $50 per ounce. The Hunt brothers' holdings were worth over $5 billion. To put that in perspective, that's roughly $18 billion in today's dollars. Two brothers from Texas had cornered the world silver market. But here's the key question. How did they do it? The answer reveals the second part of the mechanism that makes crashes inevitable. Leverage and margin rules. When you buy futures contracts, you don't pay the full price. You put up margin, typically 10 to 20% of the contract's value. If silver rises, your gains are multiplied by your leverage. If silver falls, your losses are multiplied the same way. The Hunt brothers weren't just buying silver. They were buying silver futures, taking physical delivery, then using that physical silver as collateral to buy more futures. It was a self-reinforcing loop. Higher prices meant their collateral was worth more. More valuable collateral meant they could buy more contracts. More contracts pushed prices higher. By late 1979, the COMEX had a problem. The Hunt brothers held approximately 90% of all silver futures contracts due for delivery in March 1980. That's 90%. If they demanded delivery, COMEX couldn't fulfill the orders. The silver didn't exist. Remember the 14 to 1 ratio of paper to physical? That was fine when most contracts were settled in cash, when traders closed positions before delivery dates. But the Hunts wanted metal, not cash. They were exposing the gap between paper promises and physical reality. The Commodity Futures Trading Commission, the CFTC, watched this with growing alarm. So did the Federal Reserve. So did the major banks that had lent the Hunt brothers money using silver as collateral. If silver kept rising, if the Hunts kept demanding delivery, the entire futures market structure would be exposed as what it essentially was, a fractional reserve system for commodities. Think about what this meant in practical terms. If you were a COMEX official in January 1980, you knew your exchange had sold promises to deliver 200 million ounces of silver. You knew your warehouses held maybe 120 million ounces. You knew the Hunt brothers alone could demand 90 million ounces. You knew that if they did, and if other holders followed, you couldn't deliver. Your exchange would default. The crisis wasn't about silver. The crisis was about market structure. On January 21, 1980, COMEX made an emergency rule change. New position limits capped any single trader at 3 million ounces in futures contracts. More importantly, they instituted liquidation-only trading. You could sell silver futures. You could not buy them. The only way was down. The Hunt brothers, who had accumulated their position over 7 years, suddenly couldn't add to it, but their creditors could force them to reduce it. Silver had hit $50 on January 18th. By February 14th, it was $34. By March 14th, it was $21. On March 27, 1980, a day that became known as Silver Thursday, silver opened at $15.80, and the Hunt brothers defaulted on margin calls worth $1.5 billion. Their creditors seized their silver. The price bottomed at $10.80. In 69 days, silver lost 78% of its value. The official explanation was that the Hunts had manipulated the market, that position limits were necessary to prevent corners, that Silver Thursday proved futures exchanges needed stronger regulation. That's the surface story. But here's the deeper architecture. The crash wasn't caused by the Hunts' accumulation. The crash was caused by the gap between paper and physical, by leverage ratios that assumed most contracts would be cash settled, by a market structure that depended on traders not demanding actual delivery. The Hunts exposed that structure. The CFTC and COMEX protected that structure by changing rules mid-game. And the lesson learned by every major player wasn't, don't corner markets. The lesson was, paper silver can be printed infinitely, but physical silver can't, and rule changes will always protect the paper system. That lesson set the stage for every crash since. Because the gap between paper and physical didn't shrink after 1980, it grew. By 2000, something new had entered silver markets. Exchange-traded funds, ETFs. Specifically, the iShares Silver Trust, ticker SLV, launched in 2006. For the first time, retail investors could buy silver exposure as easily as buying stocks. No storage, no insurance, no premium over spot price. Just click and own silver. Except you didn't own silver. You owned shares in a trust that claimed to hold silver in HSBC vaults in London. The silver-to-gold ratio, which had averaged 47-1 throughout the 20th century, had widened to 80-1 by 2003. Silver was historically cheap relative to gold. Investors noticed. In 2004, silver was $6 per ounce. By 2008, it briefly touched $21. The financial crisis hit, silver crashed to $9 by November 2008. Then began its most spectacular rally in history. From $9 in November 2008 to $49 in April 2011, a 444% increase in 29 months. And here's where the pattern repeats with perfect precision. COMEX silver warehouses held 103 million ounces in 2010. Open interest in silver futures contracts represented claims on over 900 million ounces. That's a 9-to-1 ratio, but it gets worse. The London Bullion Market Association, LBMA, the clearinghouse for over-the-counter precious metals trading, had daily silver trading volumes that averaged 300 million ounces per day. Global annual silver mine production was 735 million ounces per year. The LBMA was trading 40% of annual global production every single day. Where was all this silver? The answer is nowhere. It was paper silver, electronic claims, unallocated accounts where multiple customers owned the same ounces. Derivatives, where banks promised to deliver silver they didn't have if the buyer exercised the contract. The gap between paper and physical had become a chasm. In late 2010 and early 2011, something interesting happened. Buyers started demanding physical delivery from SLV, from COMEX, from dealers. Not massive amounts, but steady demand. SLV's holdings rose from 320 million ounces in 2010 to 360 million by April 2011. COMEX warehouse stocks began fluctuating as delivery demands increased. And just like 1980, just like every time, the moment physical demand pressured the paper structure, rule changes came. On March 24, 2011, CME Group, which owns COMEX, raised margin requirements on silver futures from $11,745 per contract to $14,513. On April 25th, they raised it again to $16,200. On April 29th, to $18,900. On May 2nd, to $21,600. 5 margin increases in 6 weeks. Each increase meant traders needed more cash to hold positions. Each increase forced leveraged bulls to sell. Silver peaked at $49.80 on April 28, 2011. By May 12th, it was $33. By September 2011, it was $26. The crash had begun. But this crash was slower than 1980. Silver didn't lose 78% in 69 days. It lost 50% over 14 months, then stabilized, then crashed again in 2013 to $18. The mechanism was the same, but stretched over longer time frames. Why? Because the 2011 bull market was broader than the Hunt Brothers corner. It was millions of retail investors globally, ETF holders, Indian jewelry demand, Chinese investment demand. You can't force liquidate millions of retail investors as quickly as you can break two brothers from Texas. But you can break them. It just takes longer. And by 2015, silver had settled into a range between $14 and $18 per ounce, occasionally dipping to $13. The bull market was over. The structure had held. Paper silver had defeated physical silver again. So let's connect all the pieces. 7 times in the last 150 years, silver has crashed by 50% or more. 1876, 1921, 1980, 1983, 1987, 2011, 2013. Every crash followed the same pattern. Rising prices driven by physical demand or investment flows. Leverage ratios expanding as paper claims multiplied. A trigger moment when physical demand pressured the paper structure. Rule changes by exchanges or central bank policy shifts. Forced liquidation of leveraged positions. Crash. And right now, in 2024 and 2025, every single element of that pattern is reassembling. Sign 1, the silver to gold ratio. In 2020, it hit 125 to 1, the highest in recorded history. As of late 2024, it stands around 87 to 1, still well above the historical average of 50 to 1. When this ratio reaches extremes, it means silver is extremely cheap relative to gold, or gold is extremely expensive relative to silver. Either way, it's unsustainable. And when unsustainable ratios correct, they don't correct gently. Sign 2, COMEX warehouse stocks. In 2020, COMEX warehouses held 400 million ounces of silver, the highest level in decades. By mid-2024, that number had fallen to approximately 270 million ounces, a 33% decline. Meanwhile, open interest in silver futures has remained above 900 million ounces. The ratio of paper claims to physical inventory is widening again. We're back to 1980 territory. We're back to 2011 territory. Sign 3, industrial demand is peaking. Silver is essential for solar panels, electric vehicles, 5G infrastructure. In 2023, industrial demand consumed 520 million ounces, approximately 52% of total supply. But solar panel installation rates are plateauing in China. EV sales growth is slowing. If industrial demand drops even 10%, that's 52 million ounces of demand vanishing. What happens when the largest source of demand softens just as speculative positions reach extremes? Sign 4, speculative positioning. According to CFTC Commitments of Traders reports, managed money net long positions in silver reached their highest level since 2021. High speculative positioning means the market is crowded on one side. When everyone who wants to buy has bought, the only direction is down. And when that crowd tries to exit through the same narrow door, crashes happen. Sign 5, central bank policy. The Federal Reserve held rates at zero from 2020 to 2022, driving investors into inflation hedges like silver. In 2022 and 2023, they raised rates to over 5%. High real interest rates make non-yielding assets like silver less attractive. When carrying silver costs 5% per year in foregone interest, when you can get 5% risk-free in treasury bills, silver loses its appeal. Look at what happened after 1980. The Fed under Paul Volcker raised rates to 20%. Silver crashed for 20 years. Same mechanism playing out again. Sign 6, the ETF structure. SLV holds approximately 470 million ounces as of 2024. But here's the key. Those ounces are unallocated. Multiple ETF shares claim the same physical ounces. If even 5% of SLV holders demanded physical delivery, the fund would have to buy metal on the open market. That would spike prices. But if 5% of holders redeemed shares because silver's price was falling, the fund would have to sell metal. That would accelerate the crash. ETFs create reflexivity. They amplify moves in both directions. Sign 7, historical timing. The 1980 crash came 9 years after Nixon closed the gold window. The 2011 crash came 9 years after silver bottomed in 2002. We're now 14 years from 2011. The pattern says we're overdue. The pattern says leverage has rebuilt. The pattern says the gap between paper and physical has widened past sustainable levels. And the pattern never lies. So what happens next? If history is any guide, the sequence is predictable. First comes a catalyst, a geopolitical event, a policy shift, a default somewhere in the derivative chain, something that makes leveraged holders nervous. Then comes the first wave of selling. Then comes margin calls. Then comes forced liquidation. Then comes rule changes by exchanges to ensure orderly markets. Then comes the cascade. Silver could lose 50% in 6 months. It could lose 70% in a year. The 1980 crash took 69 days. The 2011 crash took 14 months. This one could be faster because algorithmic trading amplifies volatility. Or it could be slower because the holder base is more distributed. But the direction is clear, and the magnitude is consistent with historical precedent. Think about what this means in practical terms. If you're holding silver at $32 per ounce today, and it crashes to $16, you've lost half your capital. If you're leveraged 2 to 1, you're wiped out. If you're a mining company with $22 per ounce production costs, you're suddenly unprofitable. Mines close, workers lose jobs. Entire regions dependent on silver mining face economic collapse. That happened in Idaho in the 1980s. That happened in Mexico in 2013. It will happen again. And here's what really reveals the mechanism. Who profits from these crashes? The same entities that hold short positions in silver futures. The same banks that manage the LBMA. JP Morgan was fined $920 million in 2020 for spoofing silver markets, placing orders they never intended to execute to manipulate prices. That fine covered behavior from 2008 to 2016. 8 years of documented manipulation. The fine was paid. The behavior continues. We're not living in a world where silver prices reflect supply and demand. We're living in a world where silver prices reflect leverage ratios, rule changes, and the gap between paper claims and physical metal. The pattern says that gap is widening. The 7 signs say we're approaching the breaking point. And history says the ending is a crash that wipes out 50 to 90% of silver's value over time frames measured in months, not years. The only question is timing. Will it be 2025, 2026, or has it already begun? Silver peaked at $32.20 in May 2024. By December 2024, it was $30.50. That's a 5% decline. Not a crash yet. But remember, the 2011 peak came in April. The real crash didn't begin until September. The top is never obvious when you're at the top. It's only obvious looking back. 7 signs. 7 historical crashes. 7 times the pattern repeated, and 0 times the outcome was different. The evidence says silver is heading for a historic crash. The only question is whether this time will somehow be different. The pattern suggests it won't be, and the pattern never lies.